I think for this year, the RRR cut may be more meaningful. So in terms of the impact, I think it could be more significant as compared to the past. Why? It's because China has moving towards a market-based interest rate system. So as we know now, China is moving towards the LPR-based interest rate loan system. So I think in the past, as we know, for most of the floating loan, they are pegged to the 1-year benchmark rate. So even you cut a RRR, but your funding cost may not really change. However, going forward from March to August, China is going to reprice all the existing loan, especially the floating loan, to the LPR rates. Okay. So that may actually work because when you cut the RRR, you may potentially lead the LPR to be lower. So which means you're contributing to the lower funding costs for the society, for the real economy. That's why I think this RRR cut this year could have a bigger impact as compared to the past.
Okay, so does that help explain why, even though the magnitude of the RRR cut wasn't as large as some expected, that we won't see a liquidity crunch with Chinese New Year?
I mean, there's some kind of concern because we know in January, we have about 3 trillion liquidity gap because of the earlier Chinese New Year this year, because of tax payment, I mean, also because of the heavy issuance calendar, especially for the local government bonds. So I think altogether we have about 3 trillion. So I think this RRR cut is going to inject about 800 billion. That's not really enough. That's why the magnitude-wise, it's not really so big. That's why if you look at the market reaction, it's quite interesting. Equity market reacts positively, but bond market didn't react so much because the focus is different. For equity traders, they are more focusing on the attitude. Well, for the bond traders, they are focusing on the magnitude. So that's the difference what we are seeing.
Do you think there's a hope among those investing in equities that this could be the start of more, that there could be more coming in the way of perhaps additional RRR cuts or even further easing? And should they be holding out hope for that?
Right, because if you look at this year's policy direction, so you can see one of the changes is that China added the element we call the flexibility. But of course, flexibility doesn't mean easing. But in the current context, flexibility will add certain easing elements. That's why I think it makes sense for people to expect more, but may not be so soon. Because, I mean, in the first half of the year, we still have the constraint from the inflation. I think the CPI is remain high, right? So I think, but seems like the CPI may start to go down in the second half of the year. So that may actually potentially open the room for China to do more.
So how much easing do you expect? How many more cuts on the RRR?
I think we might potentially see 1 to 2 cuts more for this year.
What quantum?
50 basis points each.
So 100 basis points
maybe around the middle of the year. Maybe not so soon, not in the first quarter. I think the reason for them to cut RRR is really try to bring down the funding costs for the economy.
Okay. And tell me, when you're talking about seeing signs of a rebound, I mean, several people have referred to them as green shoots, whether it's the PMI data or other data points we've been tracking out of China. What are you watching out for to see whether or not this turnaround story is sustainable?
Right. I think basically what we are seeing is that manufacturing investment seems like we are start to see the sign of the bottoming out. I think that right now, whether it's sustainable or not, I think to me the key question is really whether the infrastructure investment is going to pick up.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.